Welcome to this explainer, where we're breaking down Comstock Resources' massive energy pivot and their latest financial realities from the first quarter of 2026. If you followed the natural gas sector at all, you already know the landscape is just dramatically shifting under our feet right now. So today, we aren't just looking at standard run-of-the-mill earnings. We're looking at a company trying to perfectly position itself literally right at the intersection of traditional energy and next-generation power demand. And to really understand this, we have to start right out of the gate with a completely staggering number, $16 billion. That is the estimated cost of a newly announced Texas power generation hub. It's a number so incredibly large that it immediately changes the gravitational pull of the entire region's energy market. So to make sense of all this, today's explainer is going to bridge a few different sources to cover 5 main things. First, that $16 billion Texas hub. Second, Haynesville operations. Third, Q1 2026 financials. Fourth, the Western Haynesville shift. And finally, number 5, a really interesting bond investment thesis.
All right, let's dive into part 1, the $16 billion Texas power hub.
The sheer scale of the ambition here is absolutely incredible. Comstock isn't just selling gas on the spot market anymore. They've partnered up to supply this massive facility, built and operated jointly under a U.S.-Japan trade agreement featuring NextEra Energy. It's located right in the rapidly growing CRK market, which, if you aren't familiar, manages most of Texas's electrical grid. Now, this hub will feature 5.2 gigawatts of natural gas-fired generation. And why do they need all that power? To serve up to 5 gigawatts of massive large load demand. We're talking hyperscale data centers and advanced manufacturing. By 2031, this facility alone is going to demand up to 1 billion cubic feet of natural gas per day. And the really crazy part? The goal is to provide all this dispatchable power without hiking consumer electricity bills.
Which brings us directly to part 2, Haynesville Basin operations.
To feed that future mega demand, we have to look at exactly where Comstock is pulling its gas from. And there's a really crucial geographic divide right now. On one side, we have the legacy Haynesville acreage. Think of this as their traditional bread and butter. It's mature, it's lower cost, the production is super reliable, and the midstream infrastructure is already sitting right there. But the initial production rates are a bit lower, hovering around 25 million cubic feet per day. Then, on the other side, we have Western Haynesville. This is the frontier. It requires way higher upfront costs, and they have to actually build out new midstream infrastructure. But the reward? The initial production rates, meaning the volume of gas that bursts out right when a well first turns on, are superior, hitting 30 to over 40 million cubic feet per day, alongside a much deeper overall inventory. Okay, so part 3, Q1 2026 financial reality. Let's see how this actually translates to the balance sheet. When we look at their recent consolidated statements, it tells a really fascinating story. Notice that top line. Natural gas sales were basically flat year over year, ticking up just slightly from roughly $412 million in Q1 2025 to $418 million in Q1 2026. Yet, look down at the bottom line. Comstock brilliantly managed to turn a brutal $115 million net loss from Q1 2025 into a really solid $112 million net income in Q1 2026. Their operating income also saw a really healthy jump to nearly $175 million. So, what's going on here? The crucial point is efficiency. Comstock managed to achieve a 78% unhedged operating margin in the first quarter. Basically, that metric just means they are running a highly efficient operation. They're keeping 78 cents of actual profit from every single dollar of core sales before dealing with interest, taxes, or any other financial maneuvering. In a super capital-intensive industry like natural gas, maintaining margins this high is absolutely crucial. It's what allows a company to survive pricing volatility and still fund future growth. But we also have to ask, how much actual cash is moving through the business? Tracking their EBITDA, which is basically their core cash profitability, shows us a pretty complex reality that investors are watching like hawks. We see an annual EBITDA of $638 million in 2024, stepping up to $842 million in 2025, and now clocking $211 million just in the first quarter of 2026 alone. So the cash generation is undeniably strong, up roughly 40% year over year for the quarter, but they are going to need to manage it very carefully to fund those massive capital expenditure needs out west. Now remember that huge swing from a net loss in 2025 to a net income in 2026 we talked about a minute ago? Well, a major factor driving those wild swings in reported earnings are derivative financial instruments. Basically, these are hedges. Energy companies use them to protect against sudden, massive drops in gas prices. In Q1 2025, Comstock took a punishing $330 million paper loss on these derivatives. But in Q1 2026, they flipped to a slight $2.4 million gain on the books. It's a really vital reminder that in the energy sector, top-line sales only ever tell half the story. Risk management tells the rest. There's another key metric quietly doing some heavy lifting in the background here, and that's stock-based compensation. In Q1 2026, this rose to $7.4 million, up from $4.4 million the year prior. Now, while paying employees with equity does spread company ownership slightly thinner, it serves a highly strategic purpose for them right now. It keeps vital cash inside the business. Literally every dollar they aren't paying out in cash salaries is a dollar they can deploy straight into their aggressive, capital-hungry drilling operations. And where exactly is all that cash going? Part 4, the Western Haynesville shift. We have to look at the unit economics here, because this brilliantly illustrates exactly why management is so hyper-focused on this shift. Comstock is doubling down on Western Haynesville because the underlying math is just stunning. Look at this. Their legacy acreage requires natural gas prices around $3.10 per 1,000 cubic feet just to break even. The Western Haynesville, it has a much lower break-even point of just $1.87. And it gets better. The estimated ultimate recovery, or EUR, per well is nearly triple. We're talking about 32 billion cubic feet per well compared to just 11 in the legacy areas. This right here is exactly why, out of the 9 drilling rigs they have running in 2026, 4 of them are exclusively dedicated to expanding this new Western play. Which brings us to our final section, Part 5, the bond investment thesis. So, considering all of these operational and financial realities, a really intriguing pitch came out of the Alpha Challenge. Analyzing the very same data we just walked through, their team recommended a buy on Comstock's corporate bonds maturing in January 2030, which carry a 5.875% coupon rate. In their bull case, they're actually modeling an 8.44% annualized return. They're looking at the exact same massive capital expenditures we just talked about, but instead of just seeing risk, they see clearly defined upside. Their entire investment thesis basically breaks down into a clear 3-step sequence. Step 1. Comstock leverages its premier geographic location, literally sitting next door to booming Gulf Coast LNG terminals and new domestic power hubs, to capture elevated demand over the next few years. Step 2. They use the superior margins and higher sales volumes coming out of the Western Haynesville to dramatically boost their earnings margins. And finally, Step 3, they use that resulting cash flow to drive their total debt leverage under 2.0x by the year 2027, successfully securing the safety and payout of those bonds. Which ultimately leaves us to ponder the biggest question for anyone watching this space. With a $16 billion power hub on the horizon demanding 1 billion cubic feet of gas a day, can Comstock actually execute? Can they finish their expensive pipeline buildouts in the West, overcome the upfront capital costs, and truly deliver those required high-yield margins by 2027? The data definitely shows the potential is undeniably there. But as we all know in the energy sector, execution is absolutely everything.